Good, how are you?
Good, good. Sorry for being late.
Yeah, that's good. We're just talking about some cryptocurrencies, but now if you're ready to present,
Mhm. Okay. All right. I hope everyone is doing great today. So what we're gonna be talking about today is um, margin trading. I'm gonna go ahead and share my screen. Just a second. Can you guys see my screen?
yeah,
Okay, perfect. All right. Um, so yeah, before we start with the training today, as a reminder, I'm not a financial advisor, but I'm just sharing my knowledge and information with you guys as a just in terms of for educational purpose. And yeah, anything that you take from here will definitely be taken by your own decision, right? Okay, so just an overview of what we're going to talk about. So we'll start with what is margin, and then we'll see the risk and the benefits of using margin. And then we'll talk about what is leverage ratio, as well as the key to successfully trading on margin. And I will give you a little bit of my opinion on what kind of leverage I use personally. All right. So first of all, in terms of margin trading, what margin trading is basically, it's just the ability to leverage your position when you are trading. So, for example, when you open a cash account or a TFSA or RSP account, if you put $10,000 in that account, then you have a buying power of only $10,000. But when you put $10,000 in a margin account, depending on the broker and your level of experience, you can get some broker can give you from up to from 2 to 50, and some other companies go above that. But yeah, so when you open a margin account, what you have as a deposit, what you deposit as the amount, or they are used as collaterals, then the broker is kind of giving you a loan to trade on that, to trade with it. So they give you, for example, you put a $10,000, they give you $20,000 to trade with, and it's kind of a line of credit that you can use depending on what you actually need in the market. So what is necessary to understand here is that every time you use a margin, the way you use it is kind of a two-sided sword. So as you understand, when you have more buying power, then the profit that you could make on a $10,000 investment, now you're gonna be able to make the profit on a $20,000 investment. But also the loss that you could have made on a $10,000 account, you're gonna be making more or double of that if you're trading on a $20,000 account. So it goes both ways. In terms of the benefit and the risk, we're gonna start with the risk. First of all, the first risk is the fact that you can lose more fund than what you deposited in your margin account. How does this happen? This usually happens when you are shorting a company or shorting a stock. If the stock skyrockets suddenly and it goes beyond the liquidation level, and the broker did not have the time to liquidate your position, you can owe the broker some money because your account went over the leverage. The other risk is also the fact that the firm or the broker can force sell your securities. So the broker has the privilege to sell your securities if your margin level is going beyond their risk appetite. Another risk is, of course, the fact that they can sell it without contacting you. So normally they give you a notice when you get to a margin call, which is usually 75% of your initial deposit or your initial collateral. And with that, they give you a window to rebalance your loan or to rebalance your investment or your portfolio. If you do not act on that, or the market moves quickly and it's very volatile, then if it gets to 80 and 85%, they can go ahead and liquidate your positions. So you're gonna do the first step of contacting you by sending you an email, an alert on your phone, and stuff like that. But if you do not act on that, then they have the privilege to liquidate your position. Another risk is the fact that they are not really entitled to extend your time to react on the margin call. So when they send you a text, if you tell them, for example, hey, I don't have money right now, but I will have money in 2 days or something like that, they are not entitled to wait. Depending on your collaboration or your relationship with the broker, maybe you might have something if you are a really good client from them, a really good client of them, but normally they are not really entitled to wait or to give you any extension. And another thing is, of course, for short sales position, you could there is interest rate on that. For short position, there are interest rate on that, and of course, it's kind of actually not so expensive. Now, in terms of benefits, first of all, of course, the first benefit that you have is the ability to leverage some asset. Secondly, is the ability to diversify your portfolio, even if you have a small account. Let's say, for example, for somebody who has a $10,000 account, but you want to buy, let's say, $10,000 worth of Tesla and $10,000 worth of Google, but you don't have you don't have $20,000. So now, instead of putting the whole $10,000 in one account or in one stock, now you have the ability of putting $5,000 in one stock and using $5,000 from the leverage or from the margin from the broker to have that $10,000 stake in that company. This is just an example. So if you use this same example for if you want to have multiple companies, then you can have you have a little bit of a higher way to manipulate that diversity, because with the small account you only have so much that you can put in each company. But if you want to have at least one share of every company that you want to invest in, then you can buy 75% of the share and maybe 25% from the margin or from the broker to have the full share, the full stock. So yeah, this is just an example. Now, another thing is, of course, the margin or the leverage is considered as a convenient line of credit, which you can use depending on your necessity. You don't have to use it, and so you don't have to use it, but you know that you have it there. In a situation where you get an opportunity to use it, maybe you can use it, but you don't have to use it, but you know that it is there. And another one that can be considered as a benefit is the low interest rate. Most of the time, the interest rate varies from 3 to 8% APR, which is annual value. So 3 to 8% per year. But this depends on the particular stock that you're trading and your broker. And of course, the repayment, you have a flexibility for your repayment. You can repay depending on how the market is performing for you, right? And also another thing actually that can be considered as a benefit here is the fact that you can you can claim the percentage, that the interest rate that you paid to the broker when you are doing your tax report. So the interest is tax deductible. And lastly, the ability, of course, to profit from shares that are declining. So when the market is crashing, you can make money from that too, if you are shorting the companies that are crashing. But it's a very risky position. So the third thing that we're going to talk about is, of course, the leverage ratio. Now, when it comes to the leverage ratio, as I said, depending on the broker and the particular stock that you are trading, you can have 1 to 2, 1 to 3, 1 to 5, 1 to 50. Most of the time, stock markets go to 1 to 50 maximum. I haven't seen stocks that are going beyond 1 to 50, but there are other securities that are going beyond 50. So if you're trading on futures or CFDs, then they go to 1 to 100 or even 1 to 500. So for every $1 you put, they give you $500. It's a very, very risky for Forex, for example, and futures or binary trading. Those are very, very risky. The margin is really, really high. So yeah, depending on the stock that you are trading and depending on your broker, you can get from 1 to 2 all the way up to 1 to 50. And if you're trading Forex and crypto, then you can have a little bit more than that. But also just something to keep in mind is that if you want to have a higher leverage on stocks, one of the ways of doing it is by trading options. Normally, options, when you buy one option, you have a leverage to manipulate 100 stocks, 100 value of that particular stock that you bought the option for. So it's like a 1 to 100 leverage. However, this one is pretty better in a way that your risk is limited, which is different than trading on margin. We'll probably talk about that later in another training about options. So now one of the key to a successful trading successfully trading on margin actually is, first of all, to understand your risk appetite, which is understanding how much you are willing to lose, and of course trying to calculate or analyze your risk in terms of percentages. For example, if you are trading a stock, if you are buying a stock, let's say you're buying Tesla at $100 and you use a 1 to 2 margin. So you have, I'm going to just take an example. You have $100. You want to buy Tesla, but you buy 2 Teslas by using $100 from the broker. So now you have 2 Teslas, but your initial deposit is only $100. Now, what you can understand there is that if Tesla loses 50%, then you lose your whole account. So since you use a 1 to 2 margin, then since you use a 1 to 2 leverage, then 50% will be your full 100% of your deposit. And if you use more, if you use, for example, 1 to 5, then 25% will be your full account. No, that will be if you use 1 to 4. If you use 1 to 4, 25% will be your full account. So you need to calculate it in terms of percentages. That is one of the things that have been helping me a lot. If you use in terms of percentages, then you see, okay, this particular stock that I'm trading, I'm looking to stay in this particular stock for a couple of days or whatever your plan is. And you are looking at where you get in from, and you ask yourself, okay, would this or can this go down to 50%, or can this go down to 30%? If you are willing to risk that, then you can get in. if you are not, then of course just stay away and stay safe. All right. And another very important key to successfully trading on margin is, of course, getting a great entry. So this is more in terms of technical analysis. So, for example, if you see that the stock is climbing, is going so high every day, and you just get in the stock on margin on the top of the trend, well, normally, as we all know, every time there is a climb, there is usually a decline or a correction. So, if the stock has been climbing so high, you don't want to get in at the top of the trend. But of course, if you get it, let's say, for example, we just saw uh, a strong market crash and there was a huge correction. Well, that is one of the things that can tell you, okay, like it's a little bit harder to go lower than that. So that can be a little bit of a better entry than somebody who enters on top of a trend. But somebody who enters at the bottom of a bear market, of a bearish trend, then that is a better entry, because it's like you are at rock bottom. You cannot go lower than that. You can go, but it is harder. So yeah, getting a greater entry. When you get a greater entry, you are positioning yourself to be on a successful position or on a successful journey. And of course, every time you are using that, you want to look at higher time frames. And what I mean by higher time frames, of course, you do not want to use margin by looking at a smaller time frame, like a 1 hour time frame or 4 hour time frame. But instead, you want to look at the daily or the weekly or even the monthly to see the bigger picture of the trend. All right. Do we have any question before we continue? Okay. Looks like we do not have any question
I have a
yet.
question.
Yeah.
I wanted to ask if you short sell, and how many days do you have to repurchase that stock before the bank decides to do something due to your not doing anything?
So is that if you get a margin call from short
Not
selling
if you
or
get a
just by
margin
short?
call. Like if you say you uh, purchase in your margin short account
Mm-hmm.
some stock, and you sell the stock from your margin stock account, how soon do you need to replenish the account by buying back the stock before the bank has a problem with you?
Oh, okay. Yeah, great question. Actually, you are free to sell that particular stock as long as you want. There is just an interest on that. So as long as you can sustain the position, you are good.
So is it prudent to normally close it the same day or the next day, or how soon is it typical to close that position?
Yes, so you don't have really a time frame or a requirement to close it in a specific time frame. It
Mhm.
definitely depends on you.
All right, thank you.
Yeah, no problem.
I have a question.
Yeah.
Emmanuel, so let's say you put 10,000 into your account and you bought 20,000 worth of a stock. I was just wondering, when you say it drops to 75, something about 75% margin call, does that mean if the stock drops to 15,000, that's when you get a margin call? Like, I'm just wondering about how the numbers, what that 75, 80% is when you get a margin call.
Yeah, so that would be when the value of the loan that you have is about 20. when the value of your deposit, the original deposit, is about 25% of the loan. So you lost you lost 75% of your value, your original value. Is that, let me try to put it in terms of numbers. Let me just get my calculator here.
So let's say you start with 10 and then you went and you bought $20,000 worth.
Mm-hmm. So usually when you get the loan, let's say you get a loan for $10,000, they give you another $10,000. So you are trading at $20,000.
But
now
10,000 of that is yours, right? But 10,000 of that is yours. So you're only borrowing 10, or are you borrowing 20?
Exactly.
You're borrowing 20?
No, you are borrowing 10.
10. Okay. All right.
You're using your 10.
Right.
Now, so when the 20,000 times 75. So when the value of the $20,000 that you had reaches to $15,000, then you just lost. So this means the $5,000 that you lost, that was lost, was from your deposit. So that is from you.
Oh, okay.
And yeah, so at this point they're gonna inform you like 75%. You are, so your loan to value is here. Your loan to value is at 50% here. Yeah. At this point, your loan to value is at 50%. Usually they tell you at 75%. So that would be at that would be at 17,500. They'll let you know. Now, depending on your risk appetite and your account setup, they will definitely tell you at what point they usually liquidate your position. This is not very. So 75. Is that clear?
So you're saying that if I bought $20,000 worth of stock, if it dropped to about 17.5, which is not even 25%, they would start. They might call me. It's not a big drop.
Oh. Actually, I made a mistake. When you lose, so that would be, you will get the call when you lose 75% of your original deposit. So when you lose 7,500, so this means
20,000 minus 7,500.
yes.
Oh,
So when you
okay.
get to 12, yeah, when you get there, they're gonna let you know. And
Okay.
then when you get to 12,000, they liquidate your position, and you are left with 2,000. Yeah.
Okay.
I was just a little bit there.
All right. Thanks. I got it.
Yeah. Perfect. So, all right. So, in terms of my recommendation, or what I personally use, I usually go maximum. So I set up my account to get 1 to 2 leverage, but most of the time I only use 30% of that margin power or buying power, and I use it just as a bonus to myself. I don't consider it as something that I have to use every time. But when I get a really good entry, that's only when I use 30% of it. And by 30%, this means for me to really lose my money, the particular stock has to lose 75% of its value. Okay. So yeah, this is pretty reasonable. And then when it comes to trading on real margin, I go with options. Options. The reason why I like options is that you have a limited risk compared to margin. When you go on margin, so your account can go as, especially when you're taking a short position, for example, your account can go as low as possible, like as low as the stock keep going. But on options, what you pay to buy that option is what you are risking. What you pay is what you are risking. All right. So yeah, that's pretty much it. We can look at some companies. Let me just
Emmanuel, there is a question for you from
trading to
Daniel.
here. Yeah.
Yeah, there is a question for you. You can check it.
So yeah, Daniel asked why they liquidate my position. Why? So the reason why they liquidate the position is because they don't want to lose their money. So when they loan you the $10,000, they're giving it to you because they are hoping for you to be profitable and make money out of it, but they don't want to lose their $10,000. So as per the numbers, when we looked at that, when you had the $20,000 and then you get to $12,000, 12,500. Now you see that there is still the $10,000, which is from the broker. So they have their $10,000 back, but you are only left with 2,500. So that's the reason why they have to liquidate their position. And another thing is that it's not usually, or it's not necessarily the money from the broker that you are using, but they are liquidity provider that are on the market. So it's going to be like investment bankers or other banks. They are providing liquidity to the market for them to do this. And of course, they're getting paid on the interest that you pay every time you use money. As you pay the interest, they are paying it to the bank and the liquidity provider. But of course, they want to guarantee their investors that they are not going to lose their liquidity. Yeah, if you profit, you keep the whole profit. So if you are trading the $20,000 and then it becomes 40,000, you keep 30,000 and you return the 10,000 to them. You do not have to share the profit with them or anything.
Now, is that a margin or option trade? I'm confused. Which one's which?
That is. So this is in terms of margin, but options is pretty much the same thing too. Yeah.
Okay. What's the difference between them?
Options is pretty much the same thing. Go ahead. Did you have another question?
Yeah, Jared asked, what's the difference between both margin and option?
Oh, okay. So for margin, when you buy on margin, you actually buy the stock. You have it, you own it in your account. But for options, you buy a contract. So it's like, for example, I tell Bryce, hey, Bryce, I'm going to buy your computer in the future at a certain price. We agree on that. Now, I have the right to that computer for the whole time until the expiration date. Now, if during the time that I have the right to that computer, if we agreed with Bryce that I'm going to buy that computer at $10, but the computer goes to $100, well, we have a contract with Bryce, so I can sell it at $100. I pay $10 to Bryce, and I keep the $90 to myself. So when you get in in an option position, you take a contract. You are buying a contract, but you're not buying the actual stock. And the money that you pay is a premium, which is the same thing as an insurance company. When you go to insurance company, you pay them premiums. Um, that that is like the guarantee for them to pay you when you get in an accident, or to recover, to indemnify you from the loss that you sustain in an accident. Now, when I pay a premium to Bryce to get in an option contract, the premium that I pay to him is a guarantee for him to tell me that he's going to give me that computer. So it's a fee that I pay to him to get in that contract. And that's why it's kind of low. You can get it at, yeah, it's usually valued at 10 cent, no, 1 cent of the particular stock. So it's like a 100%, 100 times leverage. Sometimes the leverage can be, the options can be modified, but most of the time and normally it is at 100 times stocks.
Okay,
So
thank you.
is that clear enough?
Yeah, yeah.
Okay, perfect. All right. So yeah, I don't think we have time to
I
go
have a
into some
question.
stuff anymore.
I don't know if you can hear me.
Okay, go ahead.
Ramat.
Was it
Okay,
Ramat?
so yes. So what happens to the loss? Like okay, the example you gave, if you go all the way to 12,500, they would liquidate you. So what about because you know they are charging you percentage per day or something like that. So what happens to the value the percentage they are charging you per day for for that? That's my first question.
Okay, yeah.
Then the second question I have is, in terms of, I know all these feature things. I mean, these features and margin also applies to crypto trading. I know it's not a financial advice, but what would you, how, what is the best position one can take in terms of crypto trading? Because you know the volatility is much and all that. Those are my questions.
Okay, sorry. So yeah, first of all, in terms of the interest is calculated in your P&L value, so profit and loss. Your interest is calculated in your loss. So if you gain, for example, $10,000 as profit, you will actually get 99.99 as a profit, because there is a $1 or $2 that was paid to the broker as the interest. And if you lose $75 or 75,000, then it's probably going to be 75 and $50, because there is a $50 that went to the broker as the interest for the time that you were holding the loan. So that interest is calculated in your profit and loss value. So the other question was about what is the best position to take in terms of crypto when it comes to leverage.
Yes.
Okay, yeah. So right now, first of all, crypto market is very, very, very volatile. I don't know if you've been watching it, but just the day before yesterday, most of the cryptos, they lost like 20%. Most of them had like from 10 to 20%, which is really, really bad. And one of the reasons actually why they lost so much is because there were so many people leveraging those stocks, those cryptos. So I would say for crypto to stay really away from leverage unless you know what you are doing, because crypto is very, very volatile. So it's just better holding your bags, holding your cryptos, and wait for them to increase in value, because they actually have a huge upside. You don't even need to be on leverage to profit or make that much money. So for crypto, I would stay really away unless I know what I'm doing. But when it comes to leverage in crypto, there is the possibility to do that. You have that possibility with Binance, Crypto.com, and many other exchange. But always try to stay in a really, really, really conservative level. So like the highest I would advise, or the highest I would go on crypto, would be 25. So 1 to 25, 125. I do use it sometimes, but the highest I've gone is 25. I add a 25% on my position, and that's it. Because once you go too high, they can liquidate you anytime.
Thank you very much.
No problem. All right. So yeah, thank you very much again, everyone. Just to keep in mind, this is really just for educational purpose. It is really good for you to know what is available on the market, so that you can know what are your options, right? But feel free to really be experienced first, and be confident in your trading before you proceed with this. And at least you know that this exists now, but learn your trading strategy, understand it, and practice it. Once you become profitable on spot, or once you become profitable without using leverage, and really, really profitable, and you understand what you're doing very much, then you can start trying to get into that level too. But yeah, this was really for educational purpose, for you to know what is available on the market.
All right, thank you, Emmanuel. There is few little things I would like to say before we end. So there is one thing you might have realized if you're part of the Telegram chat, that now we start doing some polls where you can actually just vote and put your answers. It's really great, guys, if you can participate, because every time when you click on the answer, you can see also what other people are doing. So we try to do that, just if sometimes you have questions about which crypto you should buy, or which stocks people are looking at. It's also great to have other opinions, right? So that's why we started doing that. If you have some questions you would like to ask the group, you can also reach out to Monica. I'm actually going to share I'm going to share yeah, exactly. So what is Telegram? So yeah, Telegram, it's a bit like WhatsApp. Yeah, it's just a group chat, and basically everyone is there. We share tips and everything. So you just have to download the app and you can join the group. If you don't have the link to the group, if you're on Meetup, it's on Meetup as well. So you can just look at the event. You can find the link right there. The other thing I'm gonna share is the event that we have that is upcoming. So this is on May 8th, and it's a workshop. So we are doing a workshop about crypto and stock investing. So if you guys are interested, you can just click on the link and join right there. So thanks again, Emmanuel. And if you're looking for the Telegram group, you can just find it on Meetup, or yeah, actually, I'm just going to share the website as well. So if you are interested to know more, you can just go on the website. All right. Thank you very much. Have a great evening.
Thanks again, everyone, for coming. Have a great evening, everyone.
Thank you.
Thank you.